Today, cobalt sits at the core of the electric vehicle revolution and the green energy transition, yet its supply chain remains fragile. A sudden mine disruption, a new ESG rule, or a policy shift in the DRC could ripple through battery makers and automakers worldwide, altering costs for OEMs such as Tesla, CATL, and LG Chem. Investors have watched cobalt's prices swing as screens connect demand from EVs with limited mine output and processing bottlenecks. This video breaks down why cobalt matters right now, what is changing, and how households and fleets could feel the consequences in their wallets and choices. At its core, cobalt is a hard, conductive metal used to stabilize lithium-ion batteries and extend life under fast charging. Most of the world's cobalt is mined in the Democratic Republic of Congo, a country that provides roughly half to two-thirds of global supply, depending on year and refinery capacity. Industrials mix cobalt with nickel and manganese to create cathodes for EVs, smartphones, and energy storage systems. But ore grades have fallen, processing costs risen, and ethical scrutiny has tightened supply chains. Producers, refiners, and battery makers race to secure material streams while customers demand reliability and lower risk. Cobalt has a long, turbulent history tied to industrial demand and conflict mining. In the 20th century, it was a byproduct of nickel and copper, rarely priced on its own. The electric era changed that, turning cobalt into a strategic commodity with bargain prices now tied to long-term battery contracts. The DRC has dominated extraction since the 1990s, with a complex network of mines, artisanal miners, and multinational groups. Prices spiked in the 2010s as EV factories expanded, then retreated after new supply from alternative sources and improved recycling. Today, the dependency risk remains a central feature of regional politics and global supply chains. Markets have priced cobalt on the future, not the present. ETFs and futures show increased volatility as car makers sign long-term supply. Battery makers like CATL, LG, and SK negotiate with miners for guaranteed volumes, while refiners push for higher purity and traceability. In London and Shanghai, price benchmarks reflect sentiment about China EV demand and Democratic Republic of Congo output. Supply chain diversification efforts include sourcing from deeper in Africa and from Canada and Australia. Recycling programs in Europe and Asia are expanding, yet recycled cobalt remains a fraction of demand. The result is persistent premium for reliable supply and policy clarity. Automakers face a double bind: secure enough cobalt now and avoid price shocks later. Battery makers must optimize chemistries to balance cobalt content against performance and cost. Mining groups in the DRC, including larger operators and artisanal miners, face governance and safety risk alongside potential revenue. Refineries and traders gain leverage from long-term contracts, while credit markets scrutinize miners' balance sheets. Governments in Africa and instrumented funds in Europe and North America weigh ESG risk and the potential for export controls. Retail and institutional investors watch supply chain stories more than metal headlines, seeking diversification within their hard asset sleeves. Geopolitics shape cobalt more than most metals. The DRC remains volatile, with external powers seeking influence over mining contracts and export routes. China anchors a large portion of demand through battery manufacturing, while Europe and the United States race to reduce reliance on foreign supply with domestic refineries and recycling incentives. ESG debates influence project approvals and artisanal mining reforms. A global push to move to higher nickel content or alternative chemistries could reduce cobalt intensity, but the transition takes years. Trade frameworks, sanctions risk, and currency fluctuations add layers of risk to price discovery and investment strategies. Supply chain resilience remains a top national security concern. Smart money is hedging cobalt risk through diversified baskets and longer-term contracts. Major funds position via commodity index products, while strategic buyers lock in volumes with miners to stabilize costs. Recycling firms and battery recyclers attract attention as a way to reduce dependency on mined cobalt. Traders monitor ESG scores and governance metrics, rewarding projects with transparent mining practices. Lithium and nickel peers compete for battery supply share, yet cobalt still underpins cathode chemistries. Retail investors access cobalt through thematic ETFs or futures spreads, looking for alpha in a volatile narrative. Sentiment swings with policy shifts and breakthrough battery technologies. Bear case warns cobalt demand could plateau if EV growth slows or battery chemistries pivot away from cobalt. A rapid transition to nickel-rich or cobalt-free designs would shrink the market dramatically. Political risk in the DRC could disrupt mines, emboldening black market supply and price spikes. Recycling progress could outpace fresh ore growth, but recyclers face cost and contamination challenges. Demand from aerospace, electronics, and defense could complicate supply balance. Imposition of stricter ESG rules or sanctions could raise costs for miners and keep investment upside capped. In short, cobalt remains exposed to policy, price, and technology cycles. Investors should monitor new battery chemistries and regional shifts. A slow ramp of new mines could extend the cycle. For retail investors, simplicity beats guessing at metallurgical details. Consider diversifying exposure through broad commodity or battery metals ETFs and avoid over-concentrating in a single miner. Use dollar cost averaging to navigate volatility and set stop losses when prices spike. Focus on quality plays with transparent supply chains and ethical sourcing. Explore recycling and synthetic battery materials as a hedge against ore shocks. Stay aware of policy changes in major consuming regions and watch for new contracts between automakers and miners. Finally, balance cobalt exposure with other hard assets to reduce risk and preserve purchasing power over time. Long-term patience and disciplined risk controls matter. Looking ahead, cobalt's path will hinge on EV demand, supply discipline, and the ability to clean up mining. Advances in battery chemistry may reduce cobalt as a share of cathodes or unlock more scalable recycling, reshaping risk and reward. The most robust exposure will come from diversified sources, transparent supply chains, and policy clarity across major markets. Analysts expect gradual price normalization as new mines come online and recycling expands, even as geopolitical tensions persist. For investors, the lesson is resilience through diversification, patience, and ongoing due diligence. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.